so pleased. This is David Finkel, and I'm so pleased to have as one of our special guests, one of the senior Maui advisors, Bill Shopoff. Many of you who've been around the Maui community have known about and have actually met at different events that Bill has been gracious enough to attend to share his expertise on different panels or leading different conversations around investments for business owners. And we're so lucky to have him here. For over 20 years, Bill has been one of the smartest, savviest investors, especially in the area of land investments and also commercial real estate. And Bill, thank you for joining us here today. I just think it's just such a great thing that for our clients, for you to be willing to do that. We're just so appreciative. I mean, there's so many things that you're telling me about a trip you're going to be taking out to Australia and Papua New Guinea, and for you to fit us in to do that, we really value you sharing the very best of your ideas. So welcome today, Bill.
Thank you, David. As always, it's a pleasure to visit with you and hopefully share some interesting thoughts that we have on the real estate market with your clientele and our friends in the Maui group.
Well, that's great. I'm going to let you take the lead here. And as we go through here, I just want people to understand, so Bill's company, the Shopoff Group, they do many different things, specializing in land and land development and land opportunities, and they're just incredibly good at it. They partner up with institutional investors and work with private investors to kind of take in a smart way, leverage the money for higher investor returns. And one of the things that Bill does is that he pays very close attention to the state of the real estate market, both residential and commercial, because his company's success is on the line for that. And Bill, I know that you spend probably certainly in the 5 figures, maybe even in the 6 figures, for different informational sources that give you kind of that insider's edge that generally only goes to large institutions. So thank you for sharing the best of what you've gleaned and giving us this most current update on the state of the market. So with that, I'll turn it completely over to you.
Great, David. I wish, thank you very much for the kind introduction. I wish it was 5 figures for the information that we glean, but we subscribe to probably 6 or 8 information sources plus one-off stuff that we go gather, and it's obviously a serious endeavor for us. So we don't have massive in-house capability. We decipher the information. We don't gather a lot of it in-house. We utilize third parties, and with technology, there's a lot of information available for free, but there's also a lot that if you want to, there's 2 things. There's information and knowledge, and I'd say the information you can get for free. We try to pay for some knowledge, and that's generally what we try to get, rather than just raw data, is a little bit of knowledge from our information providers. So appreciate that. So with this, maybe I'll just dive into this, and I have my obligatory slide here of there's certain things, and anytime we're making presentations, because we're also in the capital raising business, there's some forward-looking statements, and so I've gone through that. One of the questions people ask me, why real estate now? And I said, real estate, the recovery, is beginning now. I'd say, the last time we talked about, it's clearly beginning. It's continuing, and it's continuing to gain steam. Single family, certainly higher permit activity and starts than there was 2 years ago, not higher than a year ago. It's kind of, we're at a little bit of a plateau, and I think 2 things happen. A little bit of its pricing, and the other part is there's just a supply problem. That in the tighter markets, there's just not a lot of product available. There's not a lot of land for home builders to go build on. They theoretically have all the land that they need, but the reality is that's just not so. They have a lot of land, but it's not always in the right location, and so well-located property is going to get their attention. But clearly, the foreclosure business, not over with, but certainly not a high competition today in most marketplaces. So I'm going to make, comments generally focused. Our business is focused in the Southwest United States, and land business heavily in California, but we try to make these more global in nature, and I've got some slides in here that are going to cover most of it's kind of more national level. Multifamily business continues to be robust. Rents continue to improve. The rate of increase has slowed, but definitely still continuing. So I think we're we're definitely in a a well-shaped recovery, because I think the move out on our economy has been somewhat slow. I think it's going to hopefully lead to a longer recovery, just maybe not as robust as we'd all hoped. So, I always like to, just kind of see where we are in job growth, and as of March, or numbers that came out last month, 175,000 new jobs. We're down about 6.7% unemployment. We've been averaging just under 200,000 jobs, but we've now got 4 straight years of adding jobs. So we're getting there. We still got a ways to go. That's going to be a while. Although there's certainly some people that are talking about whether structural unemployment is going to move, instead of kind of historically been more or less 5%, where people thought, structural may now be 5.5%, 6%, just because of education, job training, and the types of jobs that we're creating. But I think one of the things that people should factor into their investment decisions, the United States is going to change, one thing very materially. We're going to become a manufacturing country again, because of natural resources, and primarily natural gas and oil, but I'll say primarily natural gas. Cheap power makes manufacturing inexpensive, and as jobs get more automated, the power becomes more important than the labor cost, and the rest of the world is losing their advantage over us. So I think you're going to see, my prediction is the next 5, 10, 15 years, it's going to be the resurgence of United States manufacturing. Very important, because that's obviously going to make us have a position that we were losing for decades. And now I think you're going to see a marked turnaround in that. So hopefully I'm right. And if a couple of years from now it proved that I was on the forefront of that, people will remember that they heard it here. So, this is just a historical chart. Where we were, recession, obviously, unemployment rates spiked up. Now we're slowly getting back down to where we were. But you can see we got a long way to go to kind of where the trough's been out of most recessions. This is a little bit behind its time, but it's we got a ways to go here. So household formation, starting to pick up steam here. During the recession, had a lot of doubling up, a lot of people not moving out, kids not moving out of their house. I experienced that myself as my son went to college, came home, lived with us for a year and a half. He's recently been one of these people forming a new household. I know he's happy, and so are we, because that's the natural migration of things. It's time for people to get out on their own and go do that, and I think most of them want to be there. So we think there's a lot of pent-up demand in household formation that's going to support residential real estate, both rental housing, both single-family and multifamily rental housing, as well as the for-sale housing business. So as this number starts to move up, we will, you can see even as it's moving up, we're still below the trend line of the last, 30 years here, so 35 years. So we think there's plenty of opportunity for new household formation to pick up steam, and as that happens, that's a driver of residential real estate. So population growth, and here's a slide that we picked because we do business in California. Population growth is spiking up. It's off a little bit, but still, you can see growth is going to slow because we're just in a generally slowing demographic as we've aged and having less children. But we're still, California is still growing. In the last few years, been growing a little faster. You can see in the recession, we got hit a lot harder than the country as a whole. But California has grown historically. You can see the red straight line there. That's the evened out line. Has grown a little bit faster than the country as a whole. So even though we are losing some population to some neighboring states for taxes and some other reasons, we gain a lot from in-migration. And so California still has a robust future ahead of it. So not too early to write us off. This slide I'm not going to spend a lot of time, but and as I haven't mentioned yet, but David, we can make these slides available and we'll give them information on it later. But this is year-over-year change in construction spending and where the money's being spent. So during the recession, you can see we spent public dollars where we were falling off the cliff on, commercial and residential. So residential dropped first, then commercial. Residential starts to lead back out. Had a little bit of overlap here, and now we're going to, continuing to see, movement up and down in both. Definitely seeing the public spending, slow down. So, pent-up demand.
You said something here. I just wanted to because I know there are people who are watching this who are pausing it and trying to seriously write things down. And you said something, and we talked about it beforehand, which was incredibly generous of you. So those of you who are watching this, Bill has graciously agreed to actually get you a complimentary PDF of all these slides, especially when you're looking at some of the detailed information that is really tough to come by. It's hard to see it on the video, but when you can look at it in black and white or in color, but in a slide, it makes it so much easier. So Bill, if they want to take advantage of that, what do they need to do? How can they get that from your office?
The best way would be to email my brother, Steve, at shopoff, SHOPOFF, at shopoff.com. And
Great.
Just let Steve know, and he'll get a set out to you. So,
to make it easier on Steve, is there something they should put in the subject line that will let him cue him in so he knows what this is about?
Maui PowerPoint will get him there.
Okay. I really appreciate you doing that. So we'll send it to shopoff, SSHOPOFF, at shopoff.com, and just put Maui slides in the subject line and inside saying, hey, I saw the great video with Bill. Can you please send me the slides? And Steve will get them. That's wonderful. Keep going, Bill. This is phenomenal.
Yeah, this will be a lot easier. This will be a lot easier with seeing them in person rather than, trying to watch it in a video where it's going to be somewhat compressed. But, look, we've got increased sales. We've got a backdrop to really very low inventories. So, last year we had average house increase of 9.6 or 9.3%, depending on whether you use the 10 or 20 city S&P composite. So many of you would let you know this is actually something you can get. You can go online to Standard & Poor's, Case-Shiller, and you can register and you can get this data on a monthly basis. So you can get it for your community, or you can get it, globally, and you can actually download this in Excel. So for data freaks, this is available to you. So, and that's actually a free item. So I like to let people know when there's, there's good resources out there. So,
absolutely.
We're at the lowest level of new home stock since October 2004. So going back, 9.5 years to get to where we were in this level of housing stock. You see new home supply, we're down here, at relatively low numbers, and you'd have to go back into here. So, you can see we got oversupplied, tied pretty closely to the recession, and then it slowly, and this little spike up here would have been the tax credit program they had for new home buyers. Would have been right in here where we beefed up supply, and then we had to slowly get back down to a market that now is no longer a market in equilibrium. We're really probably, for the most part, a seller's market in most places. Same thing here, new home sales falling, now getting back some traction and, getting near a trend line, and we get way up here where we were, kind of out of the scale of where we normally live. So I'm not going to go into great detail on every one of these, but this slide is showing the relative scale of, here's completed homes, here's what's under construction, and here's the houses that are not yet started. And you can see by any metric, if you kind of look across the red here, then you drop down to where we are, we're at low inventories. So Case-Shiller's, this is their 10-city and 20-city composite. You can see they track pretty closely, but you can see, we're back. We're in there where prices are back on the uptick. We're not back to, to where we were, but we're back here, and probably, depending on the market, we're peak in some markets, and we're probably in that, 2002, 2003 range in a lot of markets. This is again another inflation-adjusted product here, where you've got recessions laid in here in the blue, and here's real house prices. They've fallen, and now they're starting to come back. But real house prices is tracking not just house price, and this is Case-Shiller, CoreLogic, and then the Case-Shiller 20 index. So 3 different ones, and interesting to see that they track relatively closely. So, you know, when people talk about house prices, you got to look at it because there's, you know, the National Association of Realtors issues something, CoreLogic, Case-Shiller. There's, you know, Zillow now has a metric, so there's different metrics out there. And so don't be confused when you're reading headlines. I mean, that's one of the things I would, and then I would say, don't just read the headline. You have to read the article and then go look at the data, because one of the things I would tell you is reporters are not very good at, and I don't want to hurt anybody's feelings on reporters, but they're not statisticians, and they tend to show pieces of graphs instead of graphs, and they can completely distort what the story is, and frequently the headline doesn't follow what the data is. So I would just tell you to be educated on yourself. Go out and, you know, don't just live off of headlines. I would really urge you to go figure out what the real core issue is and what's driving that story, not just the story. So here's, you know, median and average home price. So median is the price at which half the homes sell above or below. Average is just that. It's an average where you take all of those numbers and compile them. So higher priced homes are going to skew that up above the median. So, but you can see we're.
Let me ask you this question here as you're doing this here. So you've shared this information so far. I know you're going to share more, but stop for a moment and just say, here's what you see this means. You know, imagine this is somebody who's saying, look, I work really hard growing my business. I put aside some net worth. I'm looking for smart ways of making good investment choices for my family's net worth. What does this information mean to them? What should someone take from that? Help us put some context or some meaning to this, if you would.
Yeah, that's good, David, because I go through data all day long, and that's not the data is pretty meaningless unless you know what we know or think we know. So, you know, we would look at these things. We're trying to figure out trends and trying to figure out where we think things are going. So here you clearly, you know, we had rising prices until they peaked. Then we had a little fall off here, which was more than a little fall off, because if you go back to, this is the little fall off. And if you bought a house here, it didn't feel like a little fall off. If you bought one back here, maybe it felt like a fall off, but it wasn't much fun. So, but you know, we're trying to generally find trends, because, and then we want to find out what's behind the trend. You know, why is it behaving the way it is, so we can make an investment decision based on that. So, you know, here are, you know, this is also CoreLogic and Case-Shiller home price forecast. So these are the top 10 hottest housing markets according to the Case-Shiller folks. You know, starting at the bottom in Memphis and the top here at Oakland, you know, between 7.3 and 9.3% gain in home prices. You know, I would say if I was just going out and picking markets, you know, if my market were among one of these markets, I might feel pretty good about it. That doesn't mean if your market isn't on there, you should feel bad. There's plenty of money to be made. You don't need to be investing in these hot markets, because the problem is, if everybody thinks prices are going to go up 9.3, you know, prices may get ahead of themselves against, you know, ahead of what real supply-demand numbers are. So these are all things that you just factor in to your decision-making. This is one I just put in for fun, which was people talk about, you know, expensive neighborhoods. This is actually picked this up out of the paper today. This is million-dollar zip codes in the country where half or more of the houses are million-dollar values. And you can see here, you know, Laguna Beach, which happens to be where I live, that comes in at the bottom of this list at only 55% of our homes and a median value of $1,093,000. And then you go up here to Newport Beach and Rancho Santa Fe at $1,007,000 and $1,924,000. Mostly I just put this in for fun, kind of interesting when people are talking about, you know, the high end, to see where the high end really is. And these would be markets that would definitely count it. I mean, look, you can come down here and you got Atherton, which is the, you know, Silicon Valley. 80% of the housing is over $1 million. I like the zip code of Newport Beach, 96%. I'd say that's where you're going to find millionaire neighbors. So maybe these are a good prospecting list for people. You know, this is some data that we get from one of our data providers, Real Estate Economics. And this is something we use to kind of formulate where we're going to do our land investing is what do we think is going to happen to house pricing, and we'll show you later why house pricing is interrelated to land values. It's intuitive, but we'll actually show you a formula on it. Various places. Generally, robust growth here in the first 2 or 3 years, the balance of 2014, 15, 16. Falling off in 17, 18. That will have satisfied demand, number one. But the other thing that's going to happen is we're going to get back into lack of affordability. And lack of affordability is going to slow down the growth in pricing. Jumping into the multifamily market, and this is just a shot, shows you kind of the markets that are happening, where they're going. How I would use this is not necessarily that I want to be all where, like this orange is above 95% occupancy and increasing. I might want to make a contrarian bet, which is, I want to be in a below 95% but increasing. So maybe I want to be in, like this color market, which is, I think this is probably Tucson or Phoenix. Don't know my geography very well over there. Hard to see the scale. The map's kind of squished. But, we try to just take those pieces of information and figure out okay, we got a piece of information. What do we do with it? Same thing here. This is, real rents near 25-year lows. So this is the nominal rents, which is what you're paying. The gray line down here is inflation-adjusted rents. And you can see inflation-adjusted rents are pretty low relative to where they've been. Real rents continue to grow, but as a relative factor of everything. So you got to look at these things and see how they match. Again, this is a pretty interesting. This is a price to rent ratio. And so, there's a time when buying was really, you could buy as cheaply as renting right down here in the curve, pretty close. Now it's started to move away again and favor on just without worrying about your house's appreciation and all the other reasons why you buy a house, which are the real reasons, by the way, why you should buy a house. These would be the other activities. If you just want to do it on dollars and cents, this was a pretty good time to buy a house in here. Still, I think, a good time, but you want to buy a house for shelter more than investment. You can buy other houses for investment. But I tend to feel fairly strongly about that. Buy something you like and buy something you afford, and that's the place you should live. And then if you like that, go buy something else to invest and rent. So just my words of wisdom, not necessarily the right way, but I don't find you can actually make your house an investment, because most people, they buy a house and they make some money on it. They sell it and they buy a bigger house and they make some money on it. So they're not really making any money because they're putting it back into lifestyle. They're enjoying the lifestyle, and that's important, but I'd like to make the distinction between the two. Here was something I wanted to, so Zelman & Associates, which is one of the groups we utilize for our research, they think there's a correlation of about a 5% increase in underlying land value from a 1% increase in home values. And that's in a finished lot. Actually, values even move even more dramatically on a paper lot. I'll show you this kind of a quick metric we do. So a house price is $300,000 this year, and the average in our market, maybe over the last few years, was a 3.7% increase. So we go over the last 20 years, that's kind of the average growth. So that $300,000 house could sell for $346,000. Now, mind you, I'm only doing a 3.7% average, but if I went back a few slides, we're going to get 3.7% in half a year, not in a year, for the next year or two, theoretically, according to Kay Schiller. I've got my direct cost and what I, made an assumption here of what my hard sticks and bricks would cost and my soft cost. I've inflated those numbers, with kind of, CPI inflation. I've got my finished lot value, and you can see the finished lot value went up quite a bit here. It went up from $99,000 to $118,000. My finishing cost only moved up a little bit, $3,800. I took a paper lot that had a value of $14,000. That paper lot is now worth $29,000. So by a 3.7% increase over 4 years, so $50,000 increase in the value of my finished house yields a value of $1.4 million of what my theoretical subdivision land was, to almost $3 million. So pretty amazing by just the metrics of what happens, of how house drives down to land value. So just interesting thing about how we do our business, and I thought we'd do just give you a quick case study of what we did. I'm trying to stay on target here, David, but in 2006, Newport Beach did a general plan amendment and created an opportunity to do some residential in a primarily commercial area. They allocated 2,200 units of new residential in the area. We ended up grabbing a piece of property in 2010, really kind of as the recession was just coming undone. Still pretty hard to get a deal done. And we bought 25 acres and got it entitled. So this is a 25-acre site here. The Pacific Ocean here would be towards the top of the screen. This had an existing semiconductor plant on it. We've got it re-entitled, and now we're beginning the first phase of development to build 483 units of apartments and sell this site wrapping around this park where the cursor is for condominiums or townhomes. This is a better depiction of it. So this is the full phase, and then this red dashed line here would be phase one. So this will be a 50 to 100 unit condo development, and then this will be 483 units of apartments that we're actually building in a partnership with a friend of mine, and he and I will build that and own it and probably operate it forever. And this is phase two that I own mostly by myself, and one of my brothers has a small piece of it. We'll be in that for a long time to come. This was actually in one of our funds, and our fund investors just realized a nice result out of that. So this is imagery that we would do. This is the architecture that we designed, and this is kind of the street scene. So this is what we do as part of our business. So we bought it in 2010. We had about 28 million capital invested, and with rents and sales price, we generated about 66 million in total revenue for a profit of just under, I guess it's 38 million in profit if my math's right, for about a 37% IRR. So this is what you can do if you find something that's out there that creates some opportunity. So these are some things we did. Is we sold a couple of deals, and able to get good results. Obviously, not guaranteeing that you could go do this if you did it, but if you did your work, you can, or even better, because you can do it on a different scale, and you may have some abilities that we don't necessarily have. So I tell you, great opportunity in real estate for people that are want to do this, and you can do it as an augment to what you do, or you could do it as your primary business. So
let me ask one last question here, Bill, as we come to an end here. And the question is this: seeing what you see in the world. And again, I always like to ask the question because I think smart people see the world fundamentally a little bit different from each other, which is nice. So as you look forward here, what do you see, and one of the opportunities that you look and say, these are the 2 or 3 opportunities that you see for someone looking to be smart with their net worth and make some good choices? What are the things that you see? Not that this is the right thing, but this is the way one person sees the world, and it just happens to be that one person, you, is pretty darn good at this stuff.
Look, I think there's a couple of things. I mean, certainly the stock market is a vast place to invest. It doesn't happen to be my place. So I have a lot of friends who do very well in it. I'm not an expert there, and so hence I'm not going to suggest that people do or don't do that. I'm just going to say that I don't feel enough that I can influence or control the outcome there. I would say, in my mind, first place people should spend their time and energy is if they have a business, their business is probably going to generate the best result for them. But the second best place, I think, is places that you can spend your time and energy is, real estate's been a good business for us. It's had its ups and downs. I mean, I've had some really hard years. I've had some good years. I've had a lot of what you would call learning. As one friend of mine called this, when the Case-Shiller Index was diving down, he calls that the period of unpleasantness. That's a kind way to say what was going on. It was pretty rough. But I think that, taking charge and taking responsibility for your saving and investing, I think you can get professional help and should get professional help, but I think you need to be active and you need to be knowledgeable. I think abdicating to experts, even if it were somebody like myself who is we believe we're somewhat expert in this field, but I still want people who do business with a firm like ours or somebody that was a firm like ours. They should still be educated about what they're doing, and they should understand it. If you can't understand what you're investing in, doesn't mean you have to know the intricate details, but if you can't grasp the basics of what's being pitched to you, I just go to pass and move on to the next thing, because there's always another great deal. There is no shortage of deals in the world. So if you're uncomfortable, stand back and wait for the next thing to come. I think as Warren Buffett calls it, he says, just remember that, investing is like playing baseball with no called strikes. The pitcher can throw as many pitches as he has to until you swing at a pitch you like. And you only strike out by swinging at the wrong balls. If you wait for the fat pitch and it's ultimately going to come, you'll get one. And, I like that theory, because sometimes I feel like I always got to be taking decisions. And, I will tell you, we make a lot of decisions here, but the fewer we make, probably the smarter we get. So maybe that would be what I would leave you with. trying to simplify things, more, and I'm the expert at creating complicated spreadsheets and models and all this, David. But I try to get my business where I can digest it into, a few things. I'll go back to this one slide. This slide. This is really the essence of our land business. Buy here, create some paper lots. And in fact, we would buy this deal, and we would typically say, okay, well, if we think the lots are worth $14,000 today, we want to buy it for something less than 14, because we're going to create them. And then, maybe we get a combination of the value from creating the lots, and then we get a little bit of lift from the, the market moving in our direction. And, we realize a nice result. It's, sorry, just jumping around here, apologize. But it doesn't take that much complication. I think your investment theory or treatise should be relatively straightforward and easy to understand. This simple is good. And as I said, I am guilty of making it complex. So, I'm going to be the first to chastise myself just a little bit.
Well, Bill, I really appreciate that. Again, for those of you watching the video, Bill is graciously giving you a way to get a copy of the video slides that are in here as a PDF. You can just send an email to Steve Shopoff, and his email is shopoff@shopoff.com. Put in the subject line Maui Slides, and make sure you say hello from us as well. And Bill, thank you for making the time here. Like I said at the very beginning here, you're a pretty busy guy, both with your business life and also making sure that you're doing some fun things outside of the business as well, like your trip coming up to Australia and that side of the world. And thank you for making the time for us. And just a quick note here, Bill. I know we mentioned before about doing a celebration party. So those of you who don't know about this, Bill mentioned this project, but this is ultimately a $500 million development project when all is said and done. I mean, it's a massive undertaking. It was a real coup that Bill and Shopoff Investments did. And Bill, you just want to mention here about in June we're going to be getting together for a party. Just maybe take 30 seconds to talk about it. Some of the people here watching might want to be joining us as a guest.
Yeah, thank you, David. Well, I know you have an event, I think it's the last weekend in June, if my memory is correct, here in Irvine, which is essentially adjacent to our offices. And just down the street is this project Uptown Newport, and our plan is to host an event with as many of the Maui participants that like, and just a general celebration. We want to share in a little more detail, what we do if anybody's interested, but really more of a celebration of what my team has accomplished and how proud I am of them. And we've been fortunate. We've been able to be exposed to the Maui group, both students and teachers, and those people helped us accomplish what we accomplished. And so I thought it'd be a great group of people to share our good fortune with and celebrate a little bit and gather people together. So we'll be putting some information together on that through you, David. But you know, we will look forward to hosting some folks. Actually, we're going to do it over at our project. We have a nice auditorium there, and have a little reception after your event. So
that's great. And that will likely be on June 29th. The workshop Bill's talking about is on the 28th and 29th. It's our Systems and Controls workshop. So just keep an eye out for the email invitation for those of you who've been engaged and involved with the Maui community. And I guess one of the themes that we look at is that sometimes in our business lives, it's hard to share the successes. As a matter of fact, it's even harder to share the successes than it is the failures. Everyone can commiserate with the failures, but some people get a little bit jealous of the successes. And one of the core values that we really work hard to inculcate into the Maui community is this idea that we really do celebrate other people's successes. We see that as a great thing. It doesn't take anything away from us. If anything, it's a great inspiration and a spark and a challenge for us to step up our game. So going there and celebrating it together, Bill, we're looking forward to it. And on behalf of everyone watching this video, thank you for putting together. It took a lot of work to pull all this data together. Thank you for sharing your best insights about what this might mean. And we really appreciate your continued participation with the Maui community. So thank you for joining us here today, Bill.
thank you, David. Look forward to visiting with you again in the near future.
All right.